Hello students, now let's see what exactly banking is all about. In case of banking children, when we say banking, when we use the term banking, savings bank account first, savings bank account. Children, we have passbook entries for these for every month. We find out the principal qualifying for interest, add all of them up, and then calculate interest on basis of 1 month. And that's the interest the person gets for a specified period, children. Usually the banks give interest at the end of 1 year. Some banks do give it at the end of 6 months. That's financial year. Should be something like April, on 31st of March to be precise, and 31st and 30th last date of September. It's 30th of September, children. Now, whatever the interest is or the period for which it is to be given interest, the question will specify it clearly, children. Let's see some examples to elaborate on that. A question says, the passbook entries of Mrs. A are given. Rate being 7%, being 5%. Calculate the interest due if account is closed on 29th September or 1st October. So children, now we'll discuss what's principal qualifying for interest. That's principal equivalent children. The first entry is only a 12th of February of 2000. We'll work with the first part being for the account being closed on 29th September. So children, whichever day of the month the account is closed, that month interest will not be given. Whichever day of the month account is closed, that month interest will not be given, children. So when you say 29th of September, there will be no interest given for the month of September, children. So for the month of September, interest will be 0. Please remember that. Now, principal qualifying for interest, principal equivalent for the month of Feb will be 0. March, April, May, June, July, August and September in this case will be 0. 1 10th of March, children, is 3100. March, children, March month there is no entry, that's 3100 rupees, and beyond that there is no entry, so it will be 3100. April, children, 1 to 10th is 3100, then it's reduced to 2300 and 3000, so we'll take the least value, that's 2300 rupees, children. They'll give interest on 2300 rupees. April, May will come out to be, children, 1 to 10 is 3000, but beyond that it's become 2300, so we'll consider that 2300. June, no entry, so 2300. July, children, July till the 10th is 3200, so we'll consider that. And the month of August, children, will come out to be 3600. September will be 0 as we discussed earlier, children. Now we add all and the amount comes out to be 16,800. So now children, we do interest equal to PTR upon 100, where time is 1 by 12. That's principal equivalent into rate, which is 5, into time, which is 1 by 12 upon 100. This cancels with this. What you're left with is 12, children. 12 will cancel with this. 12 goes in 16 once. 48 goes 4 times. 14 times 5 is 70 rupees, children. So that's the interest due if the account is closed on 29th of September. But children, if the account is closed on 1st of October, September month will be added to it, and that will be another 3600 rupees added to the principal. So principal equivalent, children, accordingly will become 20,400. And now the interest, children, would come out to be, again PTR upon 100, which would be 20,400 into 5 into 1 by 12 and 100. This will cancel with this. 12 will cancel with this, children. 1. 84. 84 goes 7 times. 17 times 5 rupees 85. So that will be the interest due to the person if the person closes the account on 1st of August, children. That's the B part. But children, if they were to ask us what is the amount the person receives, and the amount in the first case would come out to be 3600 plus 70 rupees, and in second case would come out to be 3600 plus 85 rupees, children. Please remember that. Let's take the example to elaborate on this, children. Question says, children, Mr. S account details have been given, are given. Find the amount he gets. Amount he gets if he closes the account on 30th October. So children, for a sum like this, again we'll do the same thing. We'll do principal effective. Some cases, children, the balance hasn't been given, so we make our own column. And in some rare cases, children, we also don't have the interest. Like if it's written interest over here, any specific column with the date, we have to add the previous months till there, find the interest and add it as in deposit column over there, and then proceed, children. Now here the principal effective would be for the month of Jan, Feb, March, April, May, June, July, August, and September, children. So all these months you'll have to consider because the account has been closed on the 30th of October, children. So under that circumstance, children, to find out principal qualifying for interest for every month. For the first is Jan 8th is 500 rupees, and beyond that there is no entry till the month of March, where it reduces to 400. So for the month of March it will be 400 rupees. May straight, so April will be 400, May would be June 1 to 10th will be 1900 rupees. July again it's reduced, so we'll consider the reduced amount. August will be again the reduced amount, and September last will be 3000 rupees. October will be 0 because the person closed the account in October. October would be 0 rupees because the person closed the account in October. That gives us the balance as 10,500 rupees, children. So interest would come out to be interest rate or rate of interest being 6%. So interest would be, children, PTR upon 100. That's principal effective 10,500 into rate into time upon 100. This cancels, this cancels with this to give us the balance as 52 rupees 50 paise, which is the interest. So the balance the person receives, the balance Mr. S receives is the amount that he has in the bank plus the interest. That would give us a total of 3052 rupees 50 paise, children. Let's see recurring deposit. Now, children, in recurring deposit, we basically need to follow this one formula, that's maturity value or amount is equal to principal per month into number of months plus principal per month into n plus 1 into rate upon 2400. Well, this is what the person gives to the bank, children, and this is the interest component he receives. Please remember that, children. If they only ask for the interest, then this is going to be the interest, where n is the number of months. N is number of months. It's always the time is a number of months, children, since the time is 1 by 12 always. Rate is percentage per annum, and principal per month is the amount in rupees. Let's see some sums based on this, children. Question says, children, Mr. J has a recurring deposit account of rupees 2500 per month for a period of 6 years. What will you get a time of maturity? The rate of interest is 11%. At the rate of 11.5% per annum. So children, we first start on the formula. That's maturity value is equal to principal per month into number of months, principal per month into number of months into n plus 1 into the rate upon 2400. The information we have is principal per month is 2500, rate of interest is 11.5%, number of months n is 6 times 12, that's 72 months. Now children, that makes it 2500 into number of months plus principal per month, that's 2500 into 72 into 73 into 11.5 upon 2400. Now children, we just have to multiply this. 2500 into 72 children comes out to be 1,80,000, and the interest children comes out to be 62,000 rupees, 962 rupees 50 paise, which makes the full amount that he receives on maturity 2,42,962 rupees 50 paise. That's the amount the person receives on maturity. Another question says, children, Miss S has a 5-year recurring account in Punjab National Bank and deposits rupees 240 per month. If she receives rupees 17,694 at the time of maturity, find rate of interest. So children, here also we have principal per month is equal to rupees 240. Rate we do not know, so we will take it as R only, or X%. Number of months n would be 5 times 12, that's 60. And maturity value is equal to rupees 17,694. Now children, we will write down the formula for the same. Maturity value, principal per month into n plus principal per month into n plus 1 into rate upon 2400. That's maturity value has already been given to us, children. 17,694 is equal to principal per month into n plus principal per month into n plus 1 into the rate, which is x upon 2400. This cancels with this cancels with this, children. And 240 times 60 is 14,400. 14,400 plus 366x. So this 14,400 comes here, children. So we get 366x is equal to 17,694 minus 14,400 to give us 3,294. The rate, children, accordingly comes out to be 3294 divided by 366, which is 9%. That's the rate at which the bank was giving interest. Thank you.